Hi, I'm Mark Ryder, Head of Investment Strategy at ANZ Wealth. I'm here to update you on the latest trends in financial markets so you can understand what's driving your investments and our strategy. Let's start by looking at what's happening in global markets. The US election, which is just over a month away, is dominating the headlines. In addition to that, we're seeing some central bank activity prompting rallies in equity markets. In mid-September, we saw the Bank of Japan commit to holding 10-year government bond yields at 0%. When you add this to the negative short-term interest rates adopted by some other major central banks, including the Bank of Japan early this year, you have an environment of low growth, low yield, and investors hunting for higher returns. The US Federal Reserve kept its low rates on hold despite early indications it was looking to hike them, as it looks for further confirmation of higher inflation before raising rates again. Equity markets took these central bank decisions favourably. With bond yields so low, investors seem to have the view that there's no alternative to shares, opening the door to what some market commentators are calling a new normal bubble. With relatively high rates compared to much of the world and signs of firmer commodity prices, the Australian dollar rose modestly in the past 3 months to 76.5 cents, close to the top of the range it has traded in since March. So, what may now happen? The US election, currently touted as a vote for the least unpopular candidate between Donald Trump and Hillary Clinton, will be held on November 8th, with polls currently pointing to a tight contest. The US share market in the past has been a good guide to the winner of the US presidential election, picking 19 of the last 22 contests. A rise in the market in the 3 months to the election is normally a positive sign for the candidate of the incumbent party, this time Hillary Clinton. At the moment, the S&P 500 is down a little from the 8th of August, also suggestive of a tight contest. The policies of the two main presidential candidates do favour particular parts of the US share market. Trump is viewed by many as more protectionist, which could spell changes to trade agreements and both negatively and positively impact certain companies and sectors. Biotech and pharmaceutical companies have a lot at stake in this election due to the Democrats' proposed changes to drug pricing structures. Defence is likely to strengthen whoever wins the election, but has historically been more correlated to a Republican election outcome. Clinton, on the other hand, may help bolster infrastructure, as she's currently proposing to double the amount the US spends on the sector annually, benefiting steel, rail and broadband-related companies. Some parts of the healthcare sector could come out winners due to a recommitment to the Affordable Care Act, including hospitals and healthcare technology operators. So, what other risks should be considered? Central bankers, and not just politicians, will be as, if not more important, for markets in the immediate period ahead. While monetary policy is likely to remain easy for an extended period across developed economies, there are now signs emerging that there are limits to what monetary policy can achieve, and that the current low interest rates may in fact be hurting the economy. Markets may soon have to accept that more heavy lifting to support the economy needs to be done by fiscal policy, such as government spending and/or lower taxes, and not simply even lower interest rates. Government bond yields ended the quarter up from their lows in July, suggesting the market is moving towards this view. Recent trends in equity markets have seen them outpace corporate earnings. After 7 years of recovery since the GFC, this means equities are now starting to look expensive. If earnings disappoint, or if central banks disappoint markets, share markets may come under pressure. Let's look at the implications for our investment strategy. We came into this quarter holding a defensive investment position in our diversified funds, given our view of stretched equity market valuations, only modest earnings growth, and complacency towards ever easier central bank policy. We remain cautious as markets look to the November election outcome, as well as a range of other fundamental risks. Thanks for watching. I look forward to updating you again soon.